HDFC definitely is in focus. They delivered their numbers yesterday. We're touching base right now with Mr. Keki Mistry, the Vice Chairman and CEO at HDFC Limited. Mr. Mistry, pleasure having you on board. Firstly, congratulations on a stellar set of numbers. Can you tell us what led to better NIMs, strong growth, and overall just about a slight increase in the pro forma NPA? So if you could tell us what aided that.
I would say three things. One is the growth. We did expect a strong growth, but frankly, the actual growth that we saw was even higher than what we had expected. In individual disbursements, we had a 26% growth over the third quarter of last year. So October to December 2020 was 26% higher than October to December 2019. That was one reason. The second reason was that the amount of liquidity, the surplus liquidity, when COVID happened, we mentioned to investors at that time that we will keep a significantly higher level of excess liquidity than what we are normally used to. So against a normal level, which would have been around 15 to 17,000 crores, we kept an actual level of liquidity of close to 32,000 crores in the first quarter. In the second quarter, we brought that number down to somewhere in the early 20s. And in the third quarter, we brought it down to an average of 16,800 crores. So the excess liquidity that we were carrying in the first and second quarter, which actually depressed the net interest margin and the net interest income, because this money was deployed in overnight instruments where naturally the return is going to be very low, that started yielding a higher return. So that was the primary reason. Plus the relatively cost of borrowing kept coming down and spreads were stable, but net interest margin did go up a bit.
Okay, so while there's been a beat on the margins, there's been good growth in individual loan book. Can you also shed some light on how the performance has been for non-individual loan book?
Yeah, so let me tell you, in the early part of the year itself, when we spoke to investors, we said that we would be a little slow in the non-individual business from the second quarter onwards. In the first quarter of the financial year, which is April to June, we could not do too much of individual disbursements. And therefore, as we told investors, we would do a large amount of disbursements to AAA corporates for relatively short terms. So some of that money would have got repaid during the second or the third quarter, which therefore explains the fact that the growth in that it is not reflected in a growth in the loan book, and the loan book growth on the non-individual front is a little depressed. As we get more confidence in what is happening in the market, what is happening with developers, sales have picked up a lot. We will certainly look at stepping that up a little bit, but we will continue to be very cautious in this space. But whilst we are cautious, we would expect we have some pipeline of some good loans, and hopefully some of these loans will get dispersed in the quarter ended March 21.
Right. Hi, Mr. Mistry. This is Varun also joining into the conversation. Asset quality performance, I want to talk about that. So far, there's not been any negative surprises, and that's heartening to know. So what's led to a lower reported gross NPA this time round? And of course, we'd like some color on the pro forma numbers, which of course have inched up. And if you look at it segmentally, where are you seeing more stress?
See, we must understand that COVID was a big event. People expected that for the financial sector as a whole, and I'm not talking with reference to HDFC or any particular bank or company, but generally that there would be a massive strain or a huge increase in the level of non-performing loans. Fortunately, that has not happened. But some inching up of non-performing loans would have happened. If I was to look at March, for example, in March 2020, our gross non-performing loan number was 1.99%. And when I look at that number, the pro forma number as you speak now, it is 1.91%. So it's not really gone up compared to what it was in March. If we look at the individual category, if we look at individual loans, in March 20, it was 95 basis points, and now it is 98 basis points. 3 basis points up and down is not a material number. And if you look at non-individuals, it has come down a little bit from 4.71% in March to about 4.35% in December. But going forward, we would continue to be cautious, we would continue to be mindful, and we have been very, very conservative, or should I say proactive, in terms of making provisions. So we have consistently kept making provisions in anticipation, or as we saw any degree of stress come out in the system. The total provision we carry as of 31st of December stood at 12,342 crores of rupees. And if we went strictly by what the regulations require, the NHB regulations require, where we are to provide for non-performing loans based on the period of default, then the gross non-performing loan, the regulatory provision we would have needed to carry was 6,579 crores, as opposed to the 12,342 crores we had carried. So whether NPLs next quarter go up a little bit or go down a little bit, I don't know. But what I can tell you is that the provision level we carry is very, very comfortable.
Right, thanks, sir, for spelling that out for us so clearly. So now switching gears towards demand and future growth. Based on channel checks, Tier 2 and Tier 3 are really contributing, and the budget is, of course, extended benefits to the affordable housing sector, as you very well know, and this will be on till the 31st of March, 2022. So how do you see growth ahead in this particular segment in the individual loan book and the non-individual loan book, and which pockets, according to you, are reporting the highest growth?
Look, let's first split the two between individuals and non-individuals. Non-individual loan book growth is really something which we have to decide. The demand is very much there. We are cautious. We continue to remain cautious. We've been cautious now for several quarters now, and therefore we have to some extent intentionally slowed down that growth. At some point of time, we'll have the confidence and we will take our foot off the brake, and then we can grow much faster on the non-individual front. On the individual front, I can say that it's a combination of several things. One is interest rates on housing loans are at an all-time low. In the last 40 odd years, I've never seen interest rates in India as low as they are at this point of time. We've seen housing loan rates at sub 7% in some instances where customers are very good and credit score is very good and things like that. Second is various states have done a variety of things to encourage people to buy houses in the expectation that by giving a boost to the housing sector, effectively you'll give a boost to all the core sectors of the economy. Cement, steel, paint, power, all these industries will get a boost when housing gets a boost. And for example, Maharashtra, the state of Maharashtra has lowered the stamp duty rate from 5% to 3% to 2%, provided the registration was done before 31st December, and then from January to March, it comes to 3%. So 5 to 2 and then 2 to 3. In Maharashtra branches, or we have 3 major branches in Maharashtra, or rather 4 branches. Mumbai, of course, which is the biggest, Pune, Nasik, and Nagpur, apart from a number of other offices. If you look at our branches in Maharashtra, last year in the third quarter, Maharashtra branches constituted 26% of our disbursements in the third quarter of last year. When we look at the third quarter of this year, that 26% has become 28%. So there has been a faster growth in Maharashtra than in other places. But having said that, even in the other places, the growth has been strong. Also, the important thing to recognize that the growth is not only in the lower income segment, it is also in the upper income segment. So the average loan amount has gone up to 28.5 lakhs during this 9-month period.
Mr. Mistry, interest rates have bottomed and bond yield has risen to 6.09%. It is grown 19 basis points to a 5-month high. Post the budget, how do you see your borrowing cost, and do you see more scope for margin expansion from current levels, more importantly?
No, I don't think there will be scope for margin expansion from the levels at which we are at this point of time, because we've already reached a level of excess liquidity that we would normally like to keep. We would like to keep a liquidity level of around 15 to 17,000 crores, and the average liquidity level in the third quarter was 16,800 crores. Yes, we can bring it down a little bit more, and if you bring it down a little bit more, then it'll compensate for the slight increase that we've seen in interest rates. But therefore, expansion of margins going forward, in my view, in the fourth quarter is unlikely, but I don't see any big impact on margins in any way just because there has been a slight inching up of bond yields.
Let's also talk about the FDI in insurance, which has been hiked to 74%. While it is positive for insurance space, will we see HDFC Limited get a foreign partner like Standard Life, or you could hike stake from the current 10.3% in HDFC Life Insurance, or any such development that could happen in the foreseeable future? Also, will Ergo hike stake in HDFC Ergo General Insurance business now?
Well, it's a question that Standard Life has to answer, but Standard Life has gradually reduced their stake from the peak where it was 35% to a stake which is today below 20%. We have two insurance companies, as you know. One is a life company, the other is a general company. The life company is listed, the general insurance as yet is not listed. We will have a dialogue, we will have a meeting with our partners in the general insurance business and decide what is the best step going forward in terms of listing.
Right, Mr. Mistry, you know, we've, I think, asked you a lot of questions about what's happening at HDFC, but of course, we need to get your take on the budget announcement, which just happened 2 days ago. Do you think it's going to lead to sustainable economic recovery from here on out, revive capex, and perhaps also create more employment?
Well, I think it's a growth-oriented budget. I'm personally quite comfortable with the fact that the fiscal deficit is higher than what the originally target was, and that by 2026 we will get back to what the original fiscal deficit target was. So I think it's a very growth-oriented budget, and I'm very happy that the finance minister has not resorted to increasing taxes, as you know, all kinds of rumors were there in the market about COVID tax being imposed and special taxes for people whose income is above a certain level and things like that. These steps, if they had been taken, in my view, would have been a little, it would have affected sentiments, people would have become more cautious, spending would have reduced, and so on and so forth. The best way to spur economic growth, in my personal view, is to increase spending, leave more money in the hands of people, whether it be middle-class people or whether it be rich people, because they will consume, they will spend money. And when they spend money, they will create demand. And when they create demand, automatically, manufacturers will have to produce more to satisfy that demand. And in the process of producing more, they will have to manufacture more, they'll have to hire more people, they will create more jobs, and that is what will keep the economy growing.
While we have you with us, we'd also like to discuss what's happening with the banking sector. Of course, there's been a recap announced of 20,000 crore, which is a bit low. What's your view on that? And will the creation of an ARC ultimately solve the NPA problem that's currently gripping the PSU banks and to extent the private banks as well? And it'll take some time for this ARC to come up, I'd imagine, and legislation needs to be amended. So what's your view on this?
Well, we'll have to wait and see how the ARC will come, how long it will take. It's too early for me to comment on that. But there had, obviously, after an event which is as significant as the COVID pandemic was, one should logically have expected that the stress in the banking system would naturally have gone a little higher. Having said that, it has not been as high as people expected in April and May and June, when the first numbers of moratorium came out. People were shocked that so many people had taken moratorium and things like that. But fortunately, most of these people have ended up making payments, and therefore the stress, though it may be higher than what it was a year ago, is certainly not at as even remotely as elevated a level as people had expected in May and June.